With Dodd-Frank's clearing requirements kicking in this year, collateral management is on everyone's mind. I'm Les Kovach, Editorial Director of TabbFORUM. I'm joined today by Steve Woodyatt, CEO of Object Trading. Welcome, Steve.
Thank you, Les. Pleasure.
Is collateral management a buy-side only problem?
Oh, definitely not. Maybe traditionally it might have been viewed that way, but we're seeing all participants in the trading life cycle these days having a big focus on collateral management. Good examples driving that, of course, are on the exchanges. We're seeing aggregation there to provide common platforms to allow for more efficient collateral management. We're seeing on the sell side the constant push towards better capitalisation and effectively shoring up the financial system, keeping the reputational risk low for everybody in the industry.
What are the dangers inherent in poor capital management?
Apart from systemic risk and the sorts of dangers that we see in some of the failures in the past, we're looking at reputational risk is one of the biggest. For buy sides these days and sell sides, no one wants to be the next news there. And either the asset managers, for example, have to more efficiently, the chase for alpha, they've got to more efficiently allocate capital, and they've got to start to do it dynamically. And the key for me is this dynamic nature of being able to, no longer are we talking about posting collateral at the beginning of trading sessions and adjustments at the end. We're talking about intraday margining, we're talking about intraday calls that protects and the integrity of the whole industry, and also then gives the buy sides the opportunity to perhaps switch in and out of asset classes, different strategies, much more frequently, but to better end returns.
So dynamic asset allocation is then a type of pre-trade risk control?
Well, where they meet is this is typically, people have seen pre-trade risk, of course, as a bit of a business prevention or a cost, a license to operate. Okay, and obviously over the years that's what protects the reputation. We view it quite differently. We view pre-trade risk as actually a big benefit as well, because if properly implemented, where all the parties can see the same aggregated view of their exposure to each other, then the asset managers and those taking on the risk can attempt to dynamically reallocate in near real time to different strategies, therefore better efficiently managing what limited capital they have to trade across a wider variety of market system combinations. And that's a real boon.
And there's always concern with pre-trade risk controls that they're going to add latency to the process. Mm-hmm. How much latency does something like collateral management add?
Well, it's the collateral management part, the dynamic asset allocation, is something that is done in parallel to the trading operation. So it doesn't actually impact the latency to market, the execution of the orders. The actual pre-trade risk constraint or check adds a very minuscule, these days, if properly implemented, very minuscule overhead. And that overhead has come down so markedly these days that we're talking about switching times or even the slightest extra unintended cost in a network switch or so on may actually be a bigger cost than properly evaluating key positional and cash value risk constraints in pre-trade.
Well, hopefully the industry will embrace the concept of pre-trade risk as not just a necessity, but a benefit. Steve, thanks for joining us today.
Thanks, Les. Pleasure.